As the global community remains transfixed by the ongoing friction between different age groups, a peculiar trend is surfacing beneath the surface. Social platforms are currently saturated with millennial grievances regarding the burden of student loans and Gen Z's cynical humor regarding their inability to ever participate in the housing market. On the opposite end of the spectrum, baby boomers find themselves criticized for supposedly monopolizing the Earth's finite resources. Yet, amidst this chaotic clamor, there exists a specific demographic that financial commentators have essentially chosen to ignore entirely: Generation X. These are the individuals born between the years 1965 and 1980. There are no sensationalized television dramas being produced about their lives. They are not the ones dominating cryptocurrency channels, nor are they obsessed with establishing personal brands at every possible opportunity. Nevertheless, at this very moment, they stand as the authentic sovereigns of capital. Data provided by the Federal Reserve is undeniable. The median net worth for a typical Gen X household is currently valued at $243,000. This figure is nearly 4 times higher than the wealth of millennials and approximately 8 times greater than that of Generation Z. While most people were hunting for quick fixes through podcasts and trendy financial technology applications, these individuals were quietly consolidating their positions in the market. They did not achieve this success because the system supported them, but rather in spite of it. Their primary advantage is an ingrained sense of total skepticism. They do not subscribe to the idea of a free lunch. They harbor a deep-seated distrust of financial consultants and are accustomed to validating every piece of information personally. They came of age in an environment where information was not instantly accessible via Google. If they wished to learn about investing, they had to visit a physical library, secure reference books, and meticulously study annual corporate filings. They were analyzing the letters of Warren Buffett long before he was transformed into a popular internet meme. Furthermore, they grasped the fundamental mechanics of compound interest well before it became a fashionable quote on digital platforms. This is a cohort that gained wisdom through their own painful errors in real time. The catastrophic dot-com bubble of 2001 did not force them out of the financial markets. Instead, it taught them how to differentiate genuine profitability from mere marketing hype and empty rhetoric. While the rest of the world was in pursuit of rapid wealth, they were busy constructing a foundation that remains nearly impossible to dismantle. What many observers dismiss as simple good luck for Generation X is, in reality, a form of hardened psychological resilience. Unlike those who have only known periods of constant economic expansion and cheap credit, members of Gen X are perpetually braced for an economic setback. When the financial crisis of 2008 finally arrived and the rest of the world was paralyzed by panic, this generation exhibited the lowest frequency of emotional asset liquidation. While other investors were frantically selling their holdings at the absolute bottom of the cycle, Gen Xers simply continued their methodical purchasing. Why? Because they weren't merely acting on outside advice. They had a profound understanding of exactly what they owned. Their sense of financial certainty is rooted in a base of dull, almost monotonous technical knowledge. They spent years mastering the complexities of tax regulations, the specifics of insurance policies, and the intricate details of mortgage financing. They refused to hand over their financial destiny to advisors who profit primarily from sales commissions. According to research from Vanguard, only 38% of Gen Xers seek professional investment guidance. This is 25% lower than the rate for millennials. They are essentially a generation of independent thinkers who rely exclusively on the data they have analyzed themselves. This autonomy provides them with an immense competitive edge. they are largely immune to market turbulence. When the S&P 500 index experiences a 50% decline, a Gen Xer does not call their broker in a state of distress. They recognize that this is merely a temporary sale on valuable assets. They can tell the difference between a corporation that generates actual cash flow and a failing venture surviving on venture capital and hype. For them, a financial crisis is not an existential threat. It is the optimal window to acquire the future at a significant discount. However, the true foundation of their financial power is diversification taken to its extreme limit. While other generations are only now starting to explore side projects and personal branding, Gen X has been establishing a network of alternative safety nets for decades. They integrated the concept of strategic redundancy into every facet of their lives, including their careers, revenue streams, and professional skill sets. Census statistics reveal that 34% of the workforce in this age group maintains more than one source of income. For a representative member of Gen X, a traditional full-time job is merely the visible portion of their financial life. While their primary salary manages the daily expenses and funds their retirement accounts, they invariably have another project in motion. This might involve independent consulting work, a silent stake in a family business, or perhaps a residential rental unit. This is not a desperate attempt to quit their jobs and go freelance. Rather, it is the deliberate construction of a framework that cannot be shattered by a single layoff or a localized economic downturn. This is precisely what enabled them to exert such influence after the year 2010. When the real estate market was in a state of collapse, Gen Xers possessed the liquidity and the diverse income streams necessary to take calculated risks and purchase undervalued properties. They ramped up their stock market contributions when prices were extremely low and successfully refinanced their debt at historically low interest rates. They operated with the cold efficiency of a corporation while everyone else was frozen by anxiety. As a direct result, their current level of financial stability is higher than that of any other generation, even if their total account balances are technically lower than those of the baby boomers. To them, security is not defined by a final number, but by the diversity of ways they can generate income if the global economy fails again. One of the most fascinating aspects of Generation X is that their wealth is rarely visible to the naked eye. Marketers are struggling because this group has significant capital, yet they adamantly refuse to display it. This is stealth wealth in its most concentrated form, driven by financial strategy rather than simple modesty. They are the final generation that does not treat their bank accounts as a public spectacle. While others dedicate their time to sharing photos of luxury vehicles and expensive vacations, Gen X focuses on accumulation. This behavior creates a massive strategic advantage. When nobody realizes you have money, nobody expects you to spend it. They do not participate in competitive consumption or try to impress their social circle. A typical Gen Xer might drive a 12-year-old Honda with 300,000 kilometers on it. This isn't because they cannot afford a replacement. It is because they have calculated that $45,000 placed in the market at 8% will grow to $97,000 within a decade. They prioritize nearly $100,000 in future value over the short-lived satisfaction of a new car today. Every dollar they refrain from spending on status symbols is a dollar working on their behalf. They reside in homes purchased 2 decades ago, even when they could afford grander estates. They dine at local spots and avoid pretentious venues. This anti-flash mindset serves to shield their wealth. When friends and family are unaware of your net worth, they don't ask for financial favors or expect you to cover every bill. Their capital expands in total silence while they live their private lives. Furthermore, the Gen X perspective on debt often confuses modern economists. They are not entirely against credit, but they utilize it with the precision of a surgeon. Data indicates they may carry significant mortgage balances while maintaining zero credit card debt. Their philosophy is simple. Debt is only acceptable if it pays for an asset that increases in value or produces cash. Anything else is paid for in cash or simply ignored. They took full advantage of the era of free money between 2009 and 2021, when central banks lowered interest rates to zero. Gen X homeowners refinanced their properties at 3%, securing long-term debt at rates effectively below the rate of inflation. Many used this situation to buy rental properties, turning cheap credit into income. They understood the spread. Borrowing at 3% for an asset growing at 5% is a winning move. Over time, the tenants pay off the loan while inflation shrinks the value of the principal. Simultaneously, they targeted high-interest debt with extreme aggression. Car loans and credit card balances were eliminated immediately. Their logic is based on capital allocation. A 3% mortgage is leverage that builds wealth, while 20% interest on a couch is a financial disaster. They distinguish between productive and destructive debt. One builds a balance sheet, the other steals from the future to pay for the past. This distinction is why they are structurally more secure than those trapped in high-cost liabilities. They synchronize their debt with the economic cycle. In 2011, when property values fell low, Gen X was the most active group of buyers. They were simply ready to act when others were scared. They knew the best time to borrow is when things are cheap. Because they had savings and diverse incomes, they could handle risks that others could not. The modern myth is that wealth comes from a single lucky break like Nvidia or crypto. But Gen X knows the boring truth. Wealth equals time plus discipline. Their greatest asset is not intelligence, but 26 years of market participation. If you put $156,000 into the S&P 500 in 1998 and did nothing, you would have $520,000 today. The problem is that most people try to time the market. Gen X just stayed on the train. They survived every crisis by simply never stopping their contributions. Their discipline is just a habit. They know real money grows slowly. They aren't looking for quick wins. They want compound interest. While others switch strategies every week, Gen X follows a plan from the 1990s. This predictability made them rich. Gen X didn't have an easy road. They just accepted the rules. They didn't wait for help or inheritances. Their success is a repeatable system. First, learn for yourself. Don't let advisors pick your pocket. Master the basics of taxes and cash flow. Knowledge is your armor. Second, build redundancy. One income is dangerous. Create layers so one failure doesn't ruin you. Third, practice stealth wealth. Wealth is invisible. Don't use debt for status symbols. Let your money grow quietly. Fourth, use time. Don't wait for perfection. Start today. Reinvestment and time always win. Gen X proves you don't need to be a genius. You just need to be patient and cold-blooded. While others make noise, Gen X quietly takes the world for themselves. It is quite effective.